G'day guys, it's Swale here. I'm just hopping in to talk about the Mayer multiple. It's a very simple formula which was coined by Trace Mayer, who was an early investor in Bitcoin. The community now pushes him out because of some Mimblewimble sort of disaster, but I mean personally I still respect him, and I think that the Mayer multiple is a great formula for people who wish to invest in Bitcoin. And of course, saying that, investing in Bitcoin is a risk, and I'm not your financial advisor. You should only invest in Bitcoin if you fully understand what's going on and you know how to read the markets. So that's your responsibility. So back in 2017, Preston Pysh launched this video, and he described the Mayer multiple. I'll have that in the description notes, but some people probably might get a bit confused about it. Some people might just get it straight away, but I'm just trying to explain it in a very simple format on this video. So this is Preston's website, and he goes through to explain it. The Investors Podcast. It explains everything, and that's if you want to go in there and look at the more in-depth sort of research to be able to how this came about. And of course, this Twitter account here, Tip Mayer Multiple, you can go and sign up, basically start following them, and you'll get daily updates. And today's daily update for the Mayer Multiple is 1.33. So every single day something comes through, 1.35. It basically updates according to what the current Mayer Multiple actually is. So if you want to go and figure out this sort of thing for yourself, what you can do is you can go to tradingview.com, and you can basically go in and then type in BTC USD, and you'll be able to go and get this chart. So this is just a chart of BTC USD. So basically the price action for Bitcoin. Now if you go up to indicators up here, you can basically type in 200, and you should be able to find a few categories on 200-day moving averages. So if I just click on this one, I will go to 20, 50, and 200 EMA daily. So I'll click on that. And as you can see, this indicator is now turned up. So we've got a blue indicator, a red, and a green indicator. Now the blue indicator is the 200-day moving average. The green is the 50-day, and the red is the 20-day. Okay, to give a small explanation of how these moving indicators are worked out, they are a lagging indicator. So what happens is, for a 20-day moving average, what they basically do is they collect the price on 20 consecutive days. They combine it all together, and then they divide it by 20 so that you get a one particular average, so that it smooths everything out. Same thing for the 200-day moving averages. It will pick every single price for 200 days in a row. It will combine them all together and then divide it by 200. And when it does that, it basically has one average price of what the previous 200-day prices were, and that's where it sits on the chart. So this particular price over here, 10,555, that will be what the average is over a good 200-day block. Now the reason why I find the 200-day moving average to be a very good indicator, even though it is lagging, is it does give you a bit of an idea as to when the market is overbought and when the market is basically oversold. So whenever the price crashes down below this 200-day moving average line, this area here is the best time to buy. Obviously you can see the dip is the best time to buy, but essentially every single time the market goes below this indicator, it is a good value buy. And whenever the market goes way above the actual 200-day moving average, that's when it's usually a bit overheated and a bit too bullish. And so it's probably a good time to sort of tap the brakes and go easy and maybe stop buying and wait for it to come back down again, because it will always come back down. They go up, but they generally will always come back down in some form. So the better the value buy is always down below this blue line. And as you can see here, we are screaming quite high above this average, but it's potentially a bull season, which basically means that it may stay above the 200-day moving average like for a good year now. We just don't know. So to be able to compute the Maya multiple on this chart, you basically can get a calculator. I'll clear this history so that we're all clear. So you basically can get, I should put it over here. So let's have a look. So let's pick today's price. So we've got today's price of 13,500, and we've got the 200-day moving average of 10,500. Right? If you use today's price and then divide it by the 200-day moving average, you should get the Maya multiple. So let's punch in 13,550 and then divide that by 10,500. Now I've got a result of 1.29. So that should be what the Maya multiple is. And I mean, that's about as simple as it gets, really. Essentially, whenever the price strikes the blue line itself, the Maya multiple is 1. Yeah, we've got 7,900, right? And so we've got 7,900 divided by 7,900, it equals 1. Easy, right? And for this particular instance, what we've got a bottom of 4,000, a 200-day moving average of 8.5. So what we've got is we've got 4,000 divided by 8,500, and so down here the Maya multiple was 0.47. So it was an extremely good time to buy. So effectively, whenever the Maya multiple is below 1, it's a very good time to buy. Whenever it's above 1, it's an okay time to buy. And I believe the threshold is 2.4. So when the actual price is 2.4 times what the 200-day moving average is, that is the threshold before it starts to get too expensive. Here's a few other websites here. So we've got this. This is mayamultiple.info. This has a running Maya multiple here, so it's got 1.45. And as you can see here, this yellow line on this blue chart is the 2.4 line, and you can basically track where the price is in relation to where it is on that Maya multiple line. And also Wooble's got a really good chart here as well too. So this dotted line here, that's the 2.4 threshold. And so whenever the market punches above this 2.4, that is a very good indicator of when the peak is in. So I really don't think you can go past any other indicator when it comes to simply value investing. When it comes to value investing, you just basically need to check the Maya multiple. When it hits, when it goes above 1, up to 2.4, that's the time when you could basically just take a bit of a breather and stop dollar cost averaging into it, because it gets overheated. So every single time that it goes down to the very bottom, that's the best time to go all in. And every single time it reaches the top is basically the time to either stop investing or sell the top. I mean, you just can't beat it. You can't beat it because, I mean, look at this. It hit, I can't even read it. It hit 6.4 at the top of this peak. And it looks like it hit 6.9 when it hit that peak. So every single time it's reached these peaks has been the clear indicator of the top of the bubbles. So yeah, like I said, you can't really go past the Maya multiple. And personally, I think it's always a great time to keep stacking. You know, whenever it's, say, I believe below 0.2. You know, 2.4 is the ultimate threshold, but I mean, if you do anything below 2, you're going to be better off in the long run. So yeah, try out the Mayer multiple. I think it's a good strategy to watch and to keep an eye on. All right, thanks for listening.